The New York Stock Exchange is proposing rules allowing companies to raise fresh capital in direct listings. This is a pretty major shift in how publicly traded companies will be treated here going forward in the future. This could be a really big deal. However, before we get started, everybody at home, remember this isn't investment advice, this is just commentary, so do your own research. Also, if you like what we're talking about, we'd love it if you'd like it or share it or subscribe to our channel. That's how we grow and get the word out. And finally, either yourself or bring your family and friends by the office, talk with us more about this, and if we're a good fit, maybe we could do work together. Here at Ravenna Capital, we do wealth management for all of our clients. So we'll get back to this article here. Now, we were talking right before we started recording, and I had found this one, and Bruce and Chelsea weren't too clear on it. So let me kind of explain what exactly is happening. I'll just read these 3 bullet points and then explain a little more. It says, the New York Stock Exchange proposed a rule change on Tuesday that would potentially get more companies to follow the path taken by Spotify and Slack. As currently structured, companies can't raise capital when conducting a direct listing. The topic of direct listings has gained attention as companies pursue alternatives to the traditional IPO. And then the final part here is the biggest hurdle for companies aiming to follow Spotify and Slack into the public markets is that the direct listing process they pursued doesn't currently allow businesses to raise new capital. So the NYSE is trying to fix that. So basically what's happening here is if you want to go onto the New York Stock Exchange, traditionally you go to like Goldman Sachs or Merrill Lynch or one of these big investment banks, right. Okay? And then they do all of the busy work and all the forms and all of that and get you ready, right? And then on IPO day, part of the agreement is that they'll get 30% of the shares or 40% of the shares, and they'll get them at a huge discount to whatever the IPO price is, right? That costs a lot of money for the companies. You can also do direct listing, which is you just use a little accounting firm here locally, probably not that small, but use a small little accounting firm, they'll do it all for you, and boom, you're on the exchange, but you're under the radar, and you don't have the big Wall Street powerhouse strength of a Goldman Sachs promoting you to all the different investment firms in the country, okay? You follow so far?
Got it.
Okay, so what happened recently was Spotify and Slack, they both had enough money in their company that they were able to direct list. They could go around the Goldman Sachs groups. And what made them, why it worked for them is because Spotify and Slack are both very well-known companies, so they didn't have that issue of, well, we're small and we're direct listing and nobody knows about us. They were a big company and they direct listed and went with it. And why it was really attractive for Spotify and Slack to do that was not only did they get to circumvent all the nonsense of having to work with Wall Street banks and such, but all of their initial investors, because they're both San Francisco, Silicon Valley startups, they have a ton of venture capital and whatnot behind them. So all of their early investors were rewarded even more, right? Because when they go through Wall Street says, I want 30 or 40% of that stock for myself. Well, that makes the value of those early investors even less. You know what I mean by that? The pie got smaller because Wall Street wants some of it.
So if we go this direction on, and you, what I'm hearing is that the trend is that big companies can do this. So then does it get more and more expensive for a smaller company if the investment bank doesn't have the big companies to spread the cost around?
I think actually the opposite. I think what you'd see if this rule gets approved is entrepreneurs out there creating kind of like a streamlined do-it-yourself, like a legal Zoom type thing for getting listed.
So then Wall Street would lower their prices to,
encourage
offer more benefits or less cost.
People to come in so that they do their IPO listings with them.
Right.
But there have been a lot of companies that have gone private.
That's true. It's a trend for sure. Well,
I
that's
think the article said that this would increase competition.
Mm-hmm.
Yeah, for sure. And it's also really, again, because it's really interesting that, up to this point there was kind of that, I don't know, that gateway, the gatekeepers were the Wall Street banks.
Right.
You want to be on the New York Stock Exchange, give us 40% ownership so that blah, 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 blah. And it's like, well, that, whatever. That's why Goldman Sachs has kind of a, not that's the only reason, but one of the reasons Goldman Sachs has such a negative reputation. But yeah, this is going to force more competition. And let's just say, I mean, who's a small startup right now that's started? ABC company that has a few million in. Think about C2FO here in town. Do you know C2FO? Okay, never mind. Anyway, they could, and yeah. So what it's costing, it's basically going to allow, as long as your company has the right amount of investors and money to afford listing, you could now direct list.
So does this then allow every company that's out there
If they want to
list?
could.
And then you have no volume. You might have 1,000 shares traded a day, which is going to create more volatility because now it's subject to manipulation. And when you have investment banks involved, they have a tendency to make sure that there's enough volume, make sure that there's not manipulation going on.
There could be issues with more people, I guess. There needs to be a little bit, I think, more regulation on the direct listing.
Well, it'll be like anything. It'll be a free market. Some people will try it, and there won't be much volume, and they'll fail, and maybe they'll go private, or maybe it'll just be a whatever, because that happens.
Do they have to follow the same rules as if they were doing it through Goldman Sachs?
Yeah, totally.
As far as like all the paperwork and the regulations they have
But
to
it,
follow.
but again, think of like LegalZoom.
Yeah.
You know, in the past, it was like, oh gosh, how do I do all this? And then LegalZoom came in and streamlined it and automated it and made it very simple and very cheap. And so you could start seeing that where, the Goldman Sachs method is very expensive and cumbersome.
But they also, the banks will go out and find the money, and they will take down a certain number of shares to make sure that there is support for a particular stock that's going to go public. If you have something that now, the ones that you're talking about had a ton of money behind them before they ever went public.
Right. So most likely, if this were to be allowed, you wouldn't see just any old startup getting on. It would be startups that have significant investors behind them already. Or if they don't have investors, they at least have a solid business that's got established track record and all of that.
Correct.
So yeah, this could be a really exciting way to see what happens in the future. But again, like you said a moment ago, there's a huge uptick of companies that are now going private. A lot of companies are finding how just much of a pain in the butt it is to be a publicly traded company, and how many people get in the way and start telling you to do this and do that. So I would say if this passes, the companies you would see are companies that have investors, because those investors want a way to be able to cash out without a lockup period and all of that. So I don't know, it'll be fun. Now I will say this article was written about 3 weeks ago. A week and a half ago, the SEC came out and rejected this proposal, so they're not going to allow it yet. But, it's already out. People are talking about it. I doubt that the exchanges are just going to give up. They're probably going to keep trying to pursue this, and eventually I bet you this will be allowed. So this could be it's one of those really quiet little blips on the radar, but it could have a huge impact, I think, in the future as far as what companies...
Yeah, this would be one we need to follow.
Yeah, for sure. So did that all make sense?
Yep.
Explained very well.
Okay. Any other comments? Anything you want to put on? Or are you satisfied?
More intelligent today.
Nice. Okay. Good. Okay, everybody. Thanks for watching. Again, please like, share, and comment. That's how we get these to be a little bigger. Okay. Thanks. See ya.